What I would encourage you to be is extra diligent when the property is vacant or partly vacant. And this is because what the owner can try and do is weight the outgoings to the tenants, which ultimately inflates the net rent. G'day Cliffsters, I'm Kent Cliff, making property and personal finance videos for people with a bit of money and some knowledge, but they want to take the next step to direct investing. As always, with all my videos, there is no thin marketing fluff, there is no expensive course, and there is no service upsell. Just a guy with maybe some runs on the board, giving you genuine content. Today's video is for Cliffsters who are considering commercial property investment, and when they look at a real estate ad or speak to an agent, there is a lot of foreign terms which are used that can get quite confusing. So what I thought I'd do is two things. Firstly, for the beginner viewers, I'll go through the common terms and explain them, but for people that are a little bit intermediate, I'll throw in some tips of wisdom at each point as I get prompted throughout all the definitions. So without further ado, let's get into commercial property investment terms. The first two terms I was going to talk about is yield and cap rate, which are two commonly misused terms. Firstly, let's talk about the yield. Effectively, the yield is the net rent divided by the purchase price of the property. So if, for example, the rent that you're receiving on a property is $100,000 and the property's purchase price is $1 million, that yield would effectively be 10%. The reason why this term is commonly misused is because it's interchangeable with cap rate, but cap rate is not entirely representative of a yield. A cap rate is what's called a capitalisation rate. When we refer to the yield on commercial property, we're referring to the individual return on a property which you're looking at, whereas a cap rate talks about what the market perceived return of a yield is. The calculation is the same, but they are very different things. Now, remembering the market perceived return is based on a range of different factors. This includes what the asset type is it industrial or retail or office, the age of the asset, if it's purpose built for that particular tenant, if it's over rented or market rented, the term of the lease, and the quality of the tenant if you're buying the income. The other thing worth getting your head around as an investor in commercial property is it's not just all yield driven. A lot of people that are new to commercial property investing go into it and think that the biggest possible yield that they get is the best possible deal. This is not the case. It's the risk adjusted return based on the market view of the capitalisation rate relative to the yield. For example, if a building has a bad tenant and it's over rented and it's old and it's hard to release, the actual yield that the market might sell it to you on is quite high. But also the capitalisation rate of what the market perceives value for that building might be high too. The other thing worth mentioning with capitalisation rates is there's an inverse relationship between the capitalisation rate and the building's value. For example, when the capitalisation rate of an area or an asset goes down, the actual building value goes up, provided the rent stays the same. And while we're on this topic, it's also worthwhile mentioning cap rate compression. What's that? Well, cap rate compression is where the capital market or the debt market has driven up values of assets. Because money is affordably a lot cheaper nowadays with commercial debt, people can get higher returns when they take into account gearing than what they used to, and consequently the value of assets get bid up. The next term I want to touch on is due diligence, and this is either a contract term, an option, or a period prior to making an offer where you, as the buyer, conduct a lot of research into the property to determine if all the facts and figures provided by the agent, their property manager, or the landlord is correct and accurate. With residential property, due diligence is often capped at building and pest inspections, but with commercial property, it is a little bit more involved, and it's quite common to have anywhere from 20 to 90 days to verify all the information which the agent has provided. If there's anything wrong with this information or it has changed, you can either renegotiate the deal or walk away from the contract. Some of the due diligence items which you might want to consider include, is the rent around market? You know, if for example, the tenant's coming up for an option period, if the rent is over market, you're actually incentivizing the tenant to go out and find a different property. The other thing is the net lettable area. So for example, if the lease says there's 300 square meters of net lettable area, are you actually leasing out 300 square meters area? Then you want to dig into the lease and get a good understanding around all the rights and obligations of being a landlord, including rent reviews, as well as having a look through the outgoings budget to confirm everything which is represented and all expenses which are related to the building are included in the budget. Then you want to look at the structural component of the building itself and any plants and equipment such as fire services and air conditioning, and confirming that they're all up to date and compliant. The The other thing that's important is if the tenant has a planning approval to occupy that premises, because unlike residential, different businesses need planning approvals to operate in different areas, and the list for due diligence goes on. We are not even at the end of the leases yet, so if you have learned something from this video, and most importantly have a mate that's also interested in commercial property, share this video to them. They'll then hear this, they'll then get a warm and fuzzy feeling too that you introed them to this channel. While you're at it, hit the subscribe button, hit the like button, turn on the notifications, give me some love, because this encourages me. Moving on to the different types of leases, and the first one I want to talk about is a gross lease. This is basically where the tenant pays one amount to the landlord, and then the landlord deducts all the expenses of the building out of that, and what you're left over at the end of is the net rent. When you're comparing buildings against one another, as a landlord, you always want to be dialing everything back to the net rent, because this is what ends up in your pocket at the end of the day. It's also worthwhile touching on the difference between gross rent and a gross lease, because I've just realized myself I've made a mistake in describing it. The gross lease is the document which says that the gross rent is the way it's going to be collected, and the gross rent is the total amount of collections from the tenant. Now remember how I said before, what you want to do as a landlord considering a building is dial everything back to a net rent? Well, that's my next term, is net rent, and basically think of this as what you end up at the end of the day as a landlord. So getting it right this time, the net rent is part of a net lease, and this document is basically a lease between the landlord and the tenant that sets out that the rent of the building will commonly be a square meter rate, so $1 per square meter, times the net lettable area, plus VOs, variable outgoings, plus GST. So it doesn't matter what the variable outgoings is or if the GST changes. And this gets me onto the next thing I want to talk about, which is outgoings, or VOs, which is short for variable outgoings. This includes all the expenses of holding the property, excluding interest, which we'll talk about later. So basically property management fees, land tax, rates, water rates, maintenance, strata fees, any servicing with the building such as the fire equipment or the air conditioning, almost anything which you can think of, insurances, is generally a part of the outgoings budget. Now, there are some exceptions under retail leases where in some states, or almost all states, you can't charge property management fees. Now, I've seen landlords do this two different ways. Sometimes in an informal agreement where basically the landlord passes on any invoices that they get to the tenant and the tenant just pays it direct. Or the other way is that the landlord commonly sets a budget at the start of the financial year, and then they divide that total budget by the amount of square meters of the building, they apportion that to the respective tenant, and they break it up into installments over 12 months. The tenant basically then pays a portion of the outgoings which is held by the landlord. The landlord then uses this to pay the budgeted expenses. At the end of the financial year, what they then do is check that their balance of what they budgeted is basically what they expected or what happened, and if there's any adjustments which need to be made, they're made at this time. While due diligence is still fresh in my head and we're talking about outgoings, it's worthwhile noting that if you're considering purchasing a building, you should be checking all of the outgoings costs. This includes insurances and right down to what the building is insured for, because this changes your insurance premium. And it's also worthwhile mentioning that if the building has air conditioning, cool room, or fire services, it's worthwhile getting an inventory of when the inspections were conducted. For example, if the inspections weren't conducted last year and don't fall in the VO budget, and then all of a sudden they fall within the new year when you own the building, this might be something which you have overlooked. To help work out what the outgoings are, what I would do is speak to the building's property manager, and hopefully this is independent of the selling agent, and then I would ask for the income and expenditure report for multiple years, not just the last year, but multiple years back. Then I'd go through this journal and confirm all the different expenses, how they've been incurred, when they've been incurred, and what I would expect would be anticipated in future years. As an extra pro tip here, what I would encourage you to be is extra diligent when the property is vacant or partly vacant. And this is because what the owner can try and do is weight the outgoings to the tenants, which ultimately leads to a reduction in their holding costs, which when you are looking at your own due diligence inflates the net rent, which you would anticipate if you apportion the outgoings as per what the lease says. A quick rule of thumb is looking at the variable outgoings paid by each tenant and then dividing it by the NLA and making sure that this number is fairly consistent. If there's any inconsistencies, then I'd refer back to the lease and see if there's a different way of apportioning the VOs. This brings me on to NLA, which I have just mentioned, which is short for net lettable area. Effectively, this is the square meterage which the tenant occupies within the lease. It's common that the lease, if it's a net lease, is based on $1 per square meter of NLA. Now, it's best speaking to a surveyor about how much NLA your building has, because there's all different rules and regulations. Sometimes it's the internal walls, sometimes it's the midpoint of dividing walls. So just make sure you understand where the boundaries are and confirming that the net lettable area that your tenant occupies is correct and accurate. And if the owner has been slack, what they often do is use the construction drawings rather than as constructed surveys to dictate the NLA. Sometimes this can be a little bit smaller, and what can happen is if the tenant then finds out, they can then ask you or ask the previous landlord for that rent back paid. This brings me on to Wales and not my New South Wales problem I had in my previous video. It is the weighted average lease expiry. Effectively, what that is if the building has multiple tenants and the leases are staggered, which is good as a landlord having staggered leases because you're not all vacant at the same time, then you apportion the income as the weight to how far in the future the leases expire. For example, if you have 2 tenants and one lease expires in 2 years and one lease expires in 4 years, and the rent which those tenants are paying are identical, the WALE would be effectively 3 years. Remembering, if the income from each of those tenants is different, this will impact the weighted average lease expiry. Moving from lease terms into more financial terms, the first one I want to talk about is free cash flow. Basically, free cash flow is your net rent less your interest expense. So when you're going out buying a commercial property, you'll have some equity and then you'll have some debt. That debt component will have an interest cost attributed to it. At the moment, not very much, but you will still have some interest cost. And then once you've paid that interest back to the bank, whatever's left over and is the free cash flow is what you're getting based on the equity which you have invested. Which gets me onto annualized return on equity, which I want to discuss. Now, investors come to me and say, I'm investing in this property trust or syndicate and it's paying out a return of 7.5%. They think that that return is a 7.5% yield. It's not exactly a 7.5% yield. If the building had a 7.5% yield and they were gearing it at 6%, the annualized return on equity, which is what the figure they're quoting to you is, would probably be over 8%. But there's obviously costs of running that syndicate. So being a smart commercial investor, it's not only important to compare the yield versus the capitalisation rate, it's also important to compare the yield versus what the annualised return on equity is, which then brings me on to IRR. The most basic Kent definition of what an IRR is what the expected end sale value is in the future. It is the purchase price at the start, the time in between, and then all of the cash flows that you get throughout the carry. If, for example, my annualized return on equity, which only takes into account rent coming in, is say 8.5%, the IRR might be 12% or 11% because the capital value of the building increases over time. So until you learn all the terms of commercial property investing or my next video, best of luck and goodbye.